Hi, welcome to the podcast for Chapter 7b. In this podcast, we're going to look at the direct cost variances. This is also going to be the only podcast for this week's material. When I mentioned to you earlier, I wanted to go kind of slow through Chapter 7, and I'm going to do the same thing in Chapter 8. So we really could have covered this material. We didn't have to do it over 2 weeks. But it's so important that you understand and master these variance and variance analysis. That's what makes people successful cost accountants. So it's understanding how to analyze these variances, what they mean. That's why I'm not interested in rushing through that. I want you to take your time, do the homework, make sure you understand it, and and I think that's going to be more important than hurrying through this so we can cover something else which is not nearly as important. So I want to talk about price and efficiency variances, and this is learning objective 4. This data we saw in our podcast from the previous week. This was some information here about our direct costs and overhead and actual production and so forth. Okay, so now let's look at this a little bit more closely. So we talked about standard costs, and so in this case we're looking at direct materials. So the standard direct material cost per jacket is 2 yards times $30 a square yard is $60, and that's the same $60 that we have right here. So remember that a standard cost is not only price we expect to pay for it, or the cost of the item, but also a standard quantity. In this case, each jacket is 2 yards of material. And then here you can see the actual items. We actually used 22,200 yards. Our actual price was $28 a yard, and that gave us a direct materials cost of $621,600. We've seen that number before. We'll see it again. It's in our when we were doing our flexible budgets. That was the number for actual direct material usage. All right, direct labor. In this case, we have a standard. It's 0.8 manufacturing direct labor hours to produce one jacket, and the standard rate is $20 an hour. So per jacket, it's $16 of direct labor, and again, we saw that information right here. And then our actual information, we actually used 9,000 direct labor hours. Our actual price was $22, and you see the total amount there of $198. Okay, so all product costs have level 3 variances. We're going to split level 3 variances up over 2 chapters. So in this chapter, we're going to look at the direct materials and direct labor level 3 variances. In the next chapter, chapter 8, which again we're going to split up. And we're going to do a variable manufacturing overhead, which is not very much different than our direct material and direct labor. And then we're going to do fixed overhead, which is much more complex. So, that's just something we're going to be coming into. So the direct material and direct labor have both a price and efficiency variance. And the formulas to calculate them are basically the same. So the price variance is our actual quantity times the difference between our actual price and what our budgeted price is. So the example we're working on, our budgeted price was $30. Our actual price was $28 for material, and that gives us, so it's a $2 difference times the actual quantity. Efficiency, so that's price. Efficiency relates to the quantity that we're going to use. So again, notice, by the way, notice with the price, what we're doing is we're holding quantity constant while we are analyzing the change in the price variable. With efficiency, and sometimes efficiency is called a usage variance. So usage and efficiency are pretty much interchangeable. Notice what we do here. We hold the price constant, and then we look for the change in what was our actual usage versus how much should we have used to produce this many units. And then that difference is our usage variance, or efficiency. Okay, so we've already looked at this. This is our level 2 analysis, and I want to focus on direct materials. So we saw that was our actual amount, and we had calculated that the flexible budget amount, which was the actual quantity of 10,000 jackets times the budgeted price of $60 a jacket, gave us an unfavorable flexible budget variance of 21,600. So now what we want to do is, again, we'll look at that and then we'll see how much of that was caused by a different price than what we expected, and how much of that was caused by a different usage than what we expected. Okay, so if this looks like I created it, I did. So this is the same type of thing that I wanted to, that we were doing on the previous one, right? We have this sort of variance. So we have our actual costs, and our, remember that was the we actually used 22,200 yards times $28 to give us that amount. And then our flexible budget was, we produced, we had actual units of 10,000 units, but our standard quantity was 2 yards per jacket, and our standard cost was $30. And so that's where we end up with the unfavorable flexible budget variance. All right, so let's end that. Now, this is the new one that I want to add. So this is how we figure out price and efficiency variance. Notice here I have actual input, actual price. Budgeted input allowed for actual output, budgeted price. Well, I can now put those two together and come up with actual input times budgeted price. And so this is how I can keep one variable constant over here. Actual input and actual input means that what I'm really doing on the price side is comparing actual price with budgeted price. On the efficiency or usage side, in this case, notice budgeted price, budgeted price. So I'm keeping the price the same, and what I'm doing is comparing actual quantity used versus how much I should have used to produce that many jackets. And so when I do that here, I come up with my actual quantity of 22,200 times $30 a yard. And so what I get is a favorable price variance of 44,400 and an unfavorable usage variance. So I used way more than I should have to produce that. However, it cost me less to buy that material. Okay. And then this is maybe a more this is a neater way to look at it, but I wanted to show you that same thing. So the 21,600 unfavorable, 44.4 was a favorable price variance. The material cost us less than we thought, but we used more of it than we intended. And so, I want you to think about that for a second. This happens all the time in business. If a purchasing agent is looking at buying a product, and we normally are buying it from vendor A for $30, and we see that vendor B offers a better deal, $28, well, we might jump at that, right? That is a better deal. But it's possible, and maybe that's how this variance happened, it's possible that the quality of material wasn't as good. We ended up, using more of it, wasting more of it. And so even though it looked like it made sense, hey, we can buy this for less money, it ultimately, if that's the reason this variance happened, it ultimately led to an unfavorable variance, right? Because we used more than we thought we should have. If that is truly the reason, we would have been better off spending, paying for the $30 and not using as much material. Okay, now I didn't go into the details on the direct labor hours, manufacturing labor, but it's the same process. And I'll kind of let you follow along there. We had an unfavorable variance, and some of it was usage, and some of it was price. And by the way, this also could have been related to the material. If we had inferior material, maybe that required our workers to put in more hours. And if they had to put in more hours, maybe we had to pay some of them overtime, and that's how we ended up with a higher price variance. So you can see how one little thing could actually have sort of a trickle effect through a manufacturing operation. So this is our variance summary. We have our static variance. We can break that down between sales volume, how much of it was caused by a change in volume, how much of it was caused by the way we operate, and then with the flexible budget, and we were doing materials and labor, we can end up with price variances, right, that we're paying more or less than what we thought, or usage variances. We are using more or less than what we thought. Interpreting the variances, so favorable variances increase operating income. Unfavorable variances decrease operating income. Let's think about journal entries. Each variance can be journalized, and each variance would have its own account. Favorable variances are credits. So think about it. If favorable variances increase operating income, then that must mean that they're like revenues or gains. And so they're going to have credit balances. Unfavorable variances decrease operating income. So they're going to be like expenses and losses, and so they're going to have debits. And, variances are closed out to cost of goods sold at the end of the period. So let's go ahead and journalize the direct material price variance. So we debited our direct material control account. Again, this is like our raw material account. But in this case, we're just assuming all of our materials are direct, or that we know what the materials are that are direct. And we're doing that by the 22,200 yards times $30. And maybe I'll skip down to accounts payable. But we only had to pay, you remember, we only had to pay $28 a yard. So the 22,200 square yards times the 28 gives us a credit. That's how much we're going to have to pay for that. So the difference becomes our direct materials variance. Again, it's a credit because it's favorable. Now when we get ready to use the direct materials, we're going to debit WIP for the standard amount that we should be using, 2,000 yards times $30 a yard. We're going to debit the efficiency variance. Well, let me skip that for a second. We're going to credit direct materials control for the amount that we again actually use, 22,200 times the 30, and then the difference becomes the direct materials efficiency variance. Okay, and in your textbook, you'll see those same examples for the labor if you want to look at those. Okay, so that was kind of 15 minutes. You may have paused and stopped this through the way. I hope if needed, that's what you could do. So we do just have the one podcast this week. So good luck on the assignments.